Hotel chain owner Park Hotels' 920 crore rupee IPO has opened for subscription today. The chain runs about 2,300 rooms across 30 hotel portfolio. The company also further has 21 hotels and 8 motels under development, and they also run 73 outlets of our favorite Flurys F&B chain. To discuss the issue further, we're now joined by Priya Paul, Chairperson, Executive Director at Park Hotels. Priya, thank you very much for speaking with me. I'm Reema Tendulkar. So first, let's get to the company's expansion plans. You're India's 8th largest hotel chain. You currently operate 2,298 rooms under 30 hotels, and you're planning to add 1,895 rooms. How are you planning to fund this, considering that all the money that you're raising is going into debt reduction? There is hardly any money which is going into the company which can be used for expansion.
Thank you, Reema. Actually, we really believe in the fundamentals of not just the economy, but also the hospitality industry. After a couple of really bad COVID years, I think we are all coming out of that. There is a huge supply and demand gap in almost every city, and we are located in many of these tier 1 cities, which are in the heart of the CBD. So there's a supply, and the supply is growing at roughly about 8%, and demand is 10.2%. So this will play out in the next few years. We already see rates kind of forming up in every single city. Our expansion thus far has been with a mix of owned hotels, management contracts, and lease properties. And that's how we've reached 30 hotels. It's been about a 60-year journey. And we now will build this out further through internal accruals after paying off all the debt from the IPO proceeds.
So do you have cash in the books? And talking about the debt reduction, you have debt of close to about 580 crore. 550 crore of the fresh money goes to reduce your debt. So will you be debt free? And tell us a little bit about your internal accruals. What is the free cash flow that you're generating which can fund this expansion plan?
So absolutely. Obviously, the moment we pay off this debt of 580 crores, we then will be a debt-free company. And the strategy is to keep it like that for the next few years at least, to fund our own CapEx in the existing hotels, to do an expansion of the Flurys business and taking it, as you say, from 73 to a significant presence across the country. And we also will then use this free cash, and the accumulation will be significant in the next 4 or 5 years, to fund our own properties, which are in Pune, Jaipur, EM Bypass, Kolkata, and 2 expansions in Visakhapatnam and Navi Mumbai, giving us about 830 rooms in the next few years. And this will be funded adequately from the internal accruals, and the internal accruals will also take care of all our CapEx requirements, as well as give us enough of room to look at acquisitions and new avenues for growth.
Priya, you said that the internal accruals will be sufficient for you to fund your expansion plans in existing hotels, new hotels, Flurys, etc., and also look at acquisitions. Are you looking at acquisitions?
We're always looking for opportunities, and we have grown in the past through acquisitions, and that's something that our team is actively looking in many geographies.
Fair enough. This 1,900 rooms, which you've immediately outlined, which will get added to your overall room count, when does it all come on stream? How many this year? How many next year? When are we looking at a peak addition of 4,200 crore and 4,200 rooms, and what will it do to your revenues then?
Absolutely. So we our plan is to do 56 hotels by 2026, and that's within the the documents that we've shared. And this is a combination through our owned properties, which we will build out 830. Of those, about the 200-room property in Pune, as well as a capacity extension of 80 rooms, will come on stream in FY27, followed by Visakhapatnam in 28, which is another 100 rooms. And then finally, 550 rooms, which is between EM Bypass, Kolkata, and Jaipur, which is in FY29-30. So that's the rollout on the owned properties. We have 15 signed properties for management contracts, which will open out in the next few years. As I said, taking it to 56 hotels by 2026. And on the leased properties, we are adding 3 actually this year. in the next 3 months. And those are going to be very exciting additions in palaces and other convention-related hotels.
Talking about Flurys' expansion plans, 73 outlets right now. You said there will be a significant addition. Any number? Do you plan to double it? If yes, by when?
I think more than double, but we have 73 outlets right now. We have launched in the Mumbai MMR area, and I think in the next few months, you'll be seeing a far more locations opening there. And then as we build out our factories or kitchens in Delhi, NCR, and Hyderabad, we will take this pan India. And we're very excited that this iconic, almost 100-year-old brand is going to be finally national.
When do you think Flurys will be pan India?
The plan is in the next 5 years.
5 years, Flurys will be a pan India.
Less than 5 years, actually, yeah.
God. How much does it contribute right now to your overall revenues?
Right now, about 7% of the revenues from Flurys. And by next year, which is FY25, that will be going up to 10-11%.
Got it. And the margins that Flurys has, is it similar to the margins that you have on the overall consolidated basis, 33-34%, or is it higher or lower?
No, so consolidated is 33, almost 34% for the group, and Flurys is about 20%, but that in itself is market leading, because we just believe in right sizing the type of outlets we have, and we have kind of formats that contribute to that, from a kiosk to a restaurant.
Okay. When we spoke about the IPO proceeds, you did say that 550 crore will be used to pare down your debt, and you will be debt-free, and you plan to stay debt-free for the significant future. Then tell us, why is the promoter selling? Because this issue also has an offer for sale of 320 crore, and part of it is going to be, the promoters paring down their stake. Why is that?
Well, really to make the issue size a significant size, and to make it really appealing to investors, not just in India, but also globally. So we've kind of worked out a number that would be exciting for everybody. And I think certainly that's where we're headed.
Okay, so your stake now comes down to 68%, the promoter and promoter group's entity post the issue.
Approximately.
But you're paying more than what is mandated by SEBI. Just to comply with the SEBI regulations, you had to bring it down to 75%,
yes,
but you're looking to sell it.
And
you're looking to sell more.
Yeah. No, we're not selling any more right now. This is it.
Okay, and the reason your promoters are selling is because you wanted to increase the issue size for greater participation.
Absolutely, for greater participation and to make it a...
Got it. Let's talk about your financials then. I'm looking at the margins now. Margins for the company have been on an increasing trajectory. FY21 margins were 12%, in FY22 21.8%, then FY23 and FY24 are about 33-34%. Prior to COVID, what were the margins of the company? Because FY21-22 margins, I presume, were depressed because of the COVID impact. So how should we look at the company's margins historically and going ahead?
Margin growth, so the margin growth has been it's been on the increasing trajectory post-COVID. I think what we did do is a lot of actions in COVID, into really looking at our efficiencies, and despite the COVID times, we invested in plant and machinery to actually improve those margins going forward. And I think the lessons that we learned in COVID, how to manage, how to really look at each and every cost, because you could finally see where every single cost emanated from. So those are those lessons that have gone and have improved efficiencies for us. As I said, consolidated is 33%. At a unit hotel level, it's significantly more. And because we have all types of hotels, that's why you see a 33%, which is similar to our kind of other listed peers who have a variety of businesses in their portfolio. So on the unit level, it's, of course, as I said, significantly higher than that. So this is something that we will continue improving. And, and that is something that the whole team is looking at, not just the, staff ratios, wastage, kind of more and more central purchasing and negotiations. And these are the things going forward will hold us and help us improve the margins even more.
So you're guiding for margins to improve further?
I'm not guiding anything, but the fact is that in H1 we've already done 33.4%.
Yes.
So we think that the trajectory will continue.
Okay, so the upward margin trajectory will continue. So we're going to use, take that statement. You also spoke about, margins of peers. And here again, I'm looking from the RHP. Your margins in FY23 were about 33.8%. Chalet was 42.6%. Lemon Tree was 51.3%. Indian Hotels is comparable at 32.7% EBITDA margins, but its revenue size is 10x that of yours. So can you tell us why is it that your margins are lower than peers?
So I think what we do is not just hotels and hotel rooms like some of our peers. So the strength of the park has been not just design-led and creating a design-led boutique properties across India, whether it's in the park brand or in the zone by the park brand. What we've really done is build outstanding food and beverage brands across the hotels, and we have about 81 of those in our hotels. It gives us about 39% of our revenue, and this is a very important way that we differentiate our hotels. We made them actually very sought after places to be in, whether it's for local customers or for travelers from India and global. So it's not just a room only product. We really do a lot of food and beverage and create hotels as exciting spaces to be in. And that's what leads to our outstanding 92% occupancy. And amongst all our peers, that is a consistent, our high occupancy is a consistent strength. And it's an exceptional strength, and 92% is really quite a fantastic for the company.
No, absolutely. For the last 4 quarters, your margins haven't dropped below 90%. And in the preceding quarter, it was 92.2%. So I agree. The occupancy of the company is much higher than peers. But you spoke about the contribution of F&B, the 81 restaurants that the company holds in its in your hotels. That's about 39% of their revenues. So is that something which boosts your margins, or is it something which brings down your margins? I'm still trying to make sense of your margins versus peers.
So obviously it's a blended kind of margin, and F&B contribution is about 65%, but by the time you look at the EBITDA levels and everything, and it does reduce. So, but we think that is an important strategy for us to have a strong food and beverage department and have a strong food and beverage. It gives us non-cyclical earnings. It gives us a great connect and repeat customers. Our repeat customers are 25%. We have a loyalty club which has 110,000 members and growing. And this is what gives us really customer engagement and stickiness and makes our properties very unique. So I think that is an important strategy for us to have outstanding occupancy, outstanding food and beverages, and really build loyalty through creating an outstanding, what we call it, anything but ordinary experiences.
Sure.
And hospitality is really all about that.
But if your occupancy is already so high at about 90%, 92%, the headroom to grow your occupancy is limited till incremental capacity comes to your hotels, which is not in the imminent future. So will that cap your revenue growth rates? Because even in the first half of the year, your revenue growth at 14% is lower than peers like Chalet, Lemon Tree, Indian Hotels, which have seen a growth higher than you. So is that going to be a bit of a headwind for you?
So we have, I think, it's 92%, but some of our hotels do 97, 98, 99%. So there is certainly headroom for growth. There's a lot of supply, demand, and mismatch in all the cities, as I mentioned. ARRs have already started growing much higher in Q3, and those results will be out soon. And really, there's a strengthening of ARRs and throughout the country. And I think over and above ARR, it's actually our RevPARs, which are outstanding. And we have industry-leading RevPARs in all the segments that we're in. And that is because the food and beverage revenue is there, and we make our hotels really central to each city.
You spoke about strengthening of the ARR. Now, your average room rent hovers between 6,500 in Q2, and in peak seasons, I can see it even goes up to nearly 7,300 crore. Now, again, it's lower than peers, right? You have an Indian Hotels whose ARR is close to about 18,000. You have a Chalet Hotels whose ARR is above 10,000, at least in the peak season. So what steps are you taking to improve the ARR, and are you looking to up your pricing?
Pricing is really a function of the market demand in each city. But certainly, we see a firming up of that. We have a lot of room renovation program that is already underway, and about 10 to 15% of our inventory will be in under renovation starting from March or April. We see that having an immediate impact on rates, and that's a very important part of really giving superior superior product to our customers.
So since you started off by saying that demand is outstripping supply at an industry level, supply is being added at 8.5%, 9%, while the demand is growing at 10% plus on an annual basis. Should we expect the industry to hike prices on an annual basis? Can we continue to see ARR firming up at an industry level? And if yes, by how much do you think, accounting for inflation and the gap between supply and demand?
So I don't think there's any absolute number one can give. I think, as I said, rates are dynamic. It's a function of demand and supply, and I think all our competition is constantly evaluating and watching the rates. And as you've seen, whether it's a cricket match or a G20, the moment you have an event, the rates do change, and that's like you see airline prices, and I see a lot more happening there. There's very little quality hotels opening in central locations. So that will help to push ARRs. And plus, our rates in comparison to the peer hotels across Asia, or even I'm not even looking at Europe, are significantly lower for the type of quality hotels that India has. So, from an industry point of view, I think it's only right that rates start coming up. Everybody's gone through really almost 10 years of depressed rates. And it's not as if our property prices are less. The cost to build a hotel in India is
Sure.
equal, if not, especially the luxury end. So our luxury peers have taken the rates higher, which is, and they can take it significantly higher. So I think it's only right that the rates are firming up and increasing.
So talking about quality hotels coming up in new destinations, what about Ayodhya and Lakshadweep? Are you planning to open hotels there?
We are looking at opportunities across the country, and there are just so many places in India that are unexplored and underserved by hotels. We really have only 178,000 hotel rooms across India, which is far less than some significant cities like Dubai or Singapore.
But any
So
immediate
we
plans?
really need to. Sorry, huh?
Any immediate plans to open in these two hot destinations which are in the news now?
There's nothing that I can announce right now.
Okay. What about getting back to your composition of your portfolio? About 50% plus of your room inventory is from owned hotel properties. And the revenue contribution of this is in excess of 80%, 80, 85%.
85%.
While the O&M, the operation and managed part, that constitutes about 39, 40% of your inventory. And the revenue contribution is close to 2% when I approximate it. So can you tell us the gross margins? Because a lot of your room addition is going to be coming in the O&M category. So yeah, how is this going to change your financials?
So we have management contracts across the brands. We have them in the park, and we have hotels at Goa and Indore, and we also have Zone by the Park and Zone Connect in the management contract segment. So, obviously the flow through is about 65 to 70%. So as we grow this portfolio, we will see the absolute numbers, which go straight to the bottom line. Those are going to be increasing. I think it gives us a great geographical spread, and it's this asset light strategies is an important part of our growth plans. So as we go forward, and as some of these projects which are still greenfield and brownfield come into the portfolio, you'll see a stronger bottom line coming from this segment.
Priya, one final question then. For all the viewers who are watching this IPO, your thoughts on the valuation. You're being offered at about 56, 57 times trailing PE multiple, largely comparable to the industry, yet you're a little smaller in size. So how was the valuation arrived at?
So, that's sometimes a combination of many things. But I think what we deliver is a very outstanding brand, and a lot of kind of backed by a company that's over 100 years old. We've been in the hospitality business for 60 plus years. It's a family-run business that we own and we understand, and we want to bring a long-term. We're long-term value creators, and I think that's what it stands out from us as a brand. We own and manage all our brands, and I think have really created some unique made in India brands for the global Indian. So I think we have, that's what drives our valuation, and that's what will drive what we do in the future. I operate with a vision of leadership through differentiation. And that's something that guides each and every team member of ours to create and innovate across all the brands that we build and nurture. So that's where we're headed, and that's why I think our valuation is apt.
Priya, thank you very much for joining in, and wish you and Park Hotels all the very best. Thank you.
Thank you so much. Thanks.